I guess we can get started. Well, thank you all for joining this breakout session. I know you thought you were coming for lunch or cafe or something like that. Sorry to disappoint. They took out all the tables and there's no food being served, but you'll just have to wait a bit until we hit lunchtime. And thank you for the sellout crowd, for those in the bleachers up there in the cheap seats. Great to see you up there. I'll introduce myself. My name is Michael Buckman. I'm Co-Chief Investment Officer at the Conrad and Hilton Foundation, and I am honored to be joined by our esteemed panelists sitting alongside me to talk about the topic of asset allocation today. All their full bios are found in the materials for the conference, so we won't go through their illustrative careers and all of their qualifications, but I'll quickly just run down the line so you know who's speaking to you, and then we'll dive right into the material because we have a lot to cover and not that much time. So sitting to my left, and I guess your right, is Susan Young Lee, who's Managing Director of Investments at the Broad Foundations. And then next to her is Jeremy Wolfson, who is the Chief Investment Officer of LA Water and Power Employees Retirement. Next to him is Doug Foreman, who is Chief Investment Officer at Kane Anderson Rudnick. And then bringing up the side is Brian Nick, who is Chief Investment Strategist at Nuveen. So to get things started off, we'll do a quick run down the line, and I'll pose the question just asking each of our panelists to share with the group broadly, what your organization is, who your constituency is, and then a bit on your portfolio, its size and general approach to asset allocation, how you're positioned, and with that basis, we'll then dive into some more detail. So Susan, why don't you start us off?
Sure. So I'm Susan Lee, and I am in a unique position in that we manage investments for 3 different pools of capital. 2 of them are foundation pools of capital, and 1 is associated with the family office. The 3 pools of capital are viewed holistically in that they're all associated with our principal, Eli Broad, but individually they each have different objectives, asset allocations, and liquidity profiles. I'll go through each of the 3 different pools of capital briefly. The first is the Broad Foundations. It's the largest pool of capital and the one that we're most active in. There's a smaller foundation called the Broad Art Foundation, and then there are the family assets. The Broad Foundations, being the one that we're most active in, will be the one I'll go into a little bit more detail on. It's most like an endowment model in that we invest the assets with a long-term perspective. But there are some nuances that are different from some of my foundation, endowment, and pension plan peers that are sitting here with me. The first is that while we do have a long-term perspective in investing the pool of capital, we also work for a very generous philanthropist who is a signer of the Giving Pledge. And so we also manage our spend rate and spend forecast going forward. There are 3 pillars of philanthropy that the Broad Foundation supports. The first is healthcare and medical research. An example of that is expressed through the Broad Institute, which is a leading healthcare and medical research center in Boston in partnership with Harvard and MIT. The second is the arts, so an expression of that is the Broad Museum, which is a free contemporary art museum in downtown Los Angeles. And then the third pillar is education, which has been expressed in a variety of different ways. So we have a high return expectation that we are targeting, but we also want to be mindful of liquidity. And what that has led us to has been a barbell approach, where we want to participate in risk and upside and be invested in those strategies, but at the same time we want to be mindful of liquidity and also have defensive strategies. So today, broadly speaking, we have about 45% of our portfolio allocated to defensive strategies, including cash, credit, and hedge funds. About 50% in equities, including both public and private equities, and the remainder in hard assets.
Great. Thanks, Jeremy.
Thank you, Mike. I'm honored to be here. Thank you for having me. And I am a little disappointed because Mike stole my restaurant joke, and I don't have that many jokes. So, unfortunately,
we didn't coordinate jokes during the pre-conference call.
Done a
so
better job on the conference call for next time, Mike. Thanks.
It wasn't that funny to begin with. So.
To me, it was. Anyhow, again, thank you for having me. I'm honored to be here. It's clear now, given this distinguished panel, that I was definitely selected to be the boring panelist for sure, being the only public pension plan up here. But having said that, I love what I do, and I really love our pension plan, and we have a really disciplined model. It's similar to other public plans. There's 4 plans, just to give you some background. There's 4 LA pension plans. One's the county, and then the city's broken into 3 pieces. You have the city, fire and police, and us at Water and Power. So we're about $15 billion. We were established about 75 years ago, a little bit longer than that. We are we're lucky to be one of the best funded pension plans in the nation. We're about 93.1% funded on a market value basis, about 91 on an actuarial. And we do a very structured approach to asset allocation. And so just real quick, by raising your hands, how many are familiar with the defined benefit, because we're an open plan, the defined benefit plan and the defined benefit equation? There's 4 components to that. A couple of you? No, several of you actually. All right, well then I'm going to be really boring. So it's a real simple equation. It's not like your CFA exam. It's just C plus I equals B plus C. So you have your contributions plus your investment returns equals your benefits plus your expenses. And those are 4 levers. And if your benefits go up, you're going to have to make that up either through a change in your plan structure or investment returns overall. So having said that, our allocation process is, like I mentioned, very structured in nature, just so that over the years we become very strategic in our allocation and not so tactical. We'll take tactical opportunities when we see them. We've been doing that in private equity and real estate and in the alternative spaces because we have a lot of dry powder and we've been building that platform out. So as opposed to just redistributing distributions coming back, we still have a lot of dry powder that we're allocating in that space. So just to give you a broad allocation makeup, we have about 48% global equity in the public markets, about 25% fixed income. We have 21 in alts, which is about 8% in private equity, 8% real estate, 5% hedge funds, and 5% in a real return, which is in flux right now, and we're building that out a little bit because things have changed, and a 1% cash allocation. And since we're a perpetuity, we have to be fully invested at all times. And similar to Susan, our actuarial rate of return, which is our discount rate on our liabilities, is pretty high. So we're at 7.25. We've come down. I think that's somewhat average for public plans across the nation. We actually have an asset liability study coming up this year, so I'm guessing my board will agree to drop that to 7, but even at 7, that's an aggressive number given the current environment, right? So given the position we're in being very well funded, liquidity is also very important to us. We have one of the lowest payout ratios in the nation as well, around 5%, so that we do have a lot of liquidity. We can take on illiquidity risk, but we have to manage our risk budget appropriately when we're making those decisions. And so just real quick, the process, and we can get into details if you have questions, but we start out every about 3 years with our asset allocation, asset liability study. From there, that sets our long-term strategic goals. Then we do what we call structural analysis, where we look at a major asset class. We look at that portfolio, determine if it's making sense. If we need to make some changes, we may say it's doing exactly what we want it to do, but we can make our tilts and decisions within our mandates there. Then we can develop those mandates, and then ultimately it comes down to manager selection at the end of that process. But being a public pension plan, it takes a lot of time to get things done. So it is difficult to be tactical. When there's a tactical opportunity, we sometimes would miss it if we were trying to execute on that strategy, unless we could think of it as a little bit further out down the line from a tactical perspective. So that's how we manage it.
Thanks. Now maybe shifting gears to a slightly different perspective. Doug, you can.
Yeah, thank you. Thanks for being here, or thanks for having me. We're a buy-side shop. Essentially, we're an asset manager. We've got about $27 billion under management, of which we have 2 parts to our business. We have sort of a investment management operation, which basically sells, single mandates to large institutions and mutual funds and high net worth individuals. And then we have a RIA side of our business, which is about $4.5 billion, where we advise essentially affluent investors on how to allocate all of their capital. The mix there is about 2/3 equity, about 1/3 fixed. We do have a couple percent in alternatives overall, but it's not a huge part of what we do. We're long only, active equity. Our business has continually grown over the last several years, despite the struggles that many active managers have had over the years, particularly with the rise of passive over the last decade. So we have wealth advisors that work with clients that determine their risk buckets, and we put them into 5 different buckets, basically, in terms of the risk profiles, and then allocate their assets accordingly. We're basically mainly strategic. We do make a few tactical moves here and there, but overall, it's mainly just trying to drive the client's returns based on their long-term risk profiles that they're willing to accept. So that's pretty much it for me.
Excellent. Thanks. Then we'll round it out.
Thank you. I'm also happy to be here, and thanks for having me. So I work for Nuveen, which is the asset management arm of TIAA, or what most of you might know as TIAA-CREF, before we dropped the CREF a couple of years ago. We manage about $930 billion. It might be a little bit less than that after the week we've had in the markets, but that's around there. About half of that, or a little over half of that, is the money that basically is the pool of money that's used to fund the annuity product for the teachers' retirement fund, so the legacy TIA fund. And then we have about $100 billion in real estate. We're one of the world's largest holders of wine grapes, so if you have wine tonight with dinner, you might be drinking a Nuveen or a TIA wine. Global farmland. So we basically do every type of asset class, all the way from fixed income, municipal bonds, which is what Nuveen is known for, all the way to some of the more alternative asset classes around the world. I think for the purpose of the asset allocation panel, maybe the most interesting sleeve of what we do is we have about $50 billion in multi-asset portfolios. So these are mutual funds that are target date funds, or they're assigned to a specific risk tolerance. We call them life cycle or lifestyle funds. And I work on those from an asset allocation basis, trying to figure out, well, what's the right allocation for somebody who is going to retire in 2065 versus what's the right asset allocation for somebody who is currently retired and probably has a preference for income over growth or capital preservation over growth at this point. So really interested to have the discussion here, and I guess I'll turn it back to Mike.
Yeah, so maybe building on that, I'll pick on Jeremy since he said he's the most boring on the panel. So we'll see what we can elicit from him. You talk about having, the speed at which you can move or the lack thereof, and some of the challenges there. How do you think about your asset allocation, be it strategically or tactically? And you talk about the low return environment. How do you respond to that, and how quickly can you move? And how do you think about that with your board and the way that your team works?
So that's a great question, Mike. And so to elaborate on that, it does become a challenge for sure. It does require us to, like I said, stay with regards to conceptually thinking about our portfolio and allocation from a more strategic level. Having said that, we are able to pivot in the sense that we do have that allocation study every 3 years. And so to give you an example, in my previous life, I was a bond trader. So coming into the pension plan, our entire fixed income program was nothing more than 90% of the Lehman Ag, if you date back to when I was trading bonds, and 10% high yield. And this was back when the Fed was at 0. And so I knew we were just going to get crushed when the Fed started to move, and they obviously have. So and this is years ago, by the way, this example. It's old, but it just gives you an idea of how long it takes to get there. So a couple things happened. So one was I wanted to get in front of the Fed. I wanted to ensure that we barbelled, kind of like Susan, but at least specific to fixed income, barbelled out that portfolio from a risk management standpoint. I wanted to provide some tactical, the way that we can implement and execute on tactical allocation within that portfolio. And so one worked and one didn't. So what didn't work was when the GFC hit and we saw bank loans trading in the 60s, it was like the trade of the century. I mean, if I could have executed on that, obviously they're back in the 90s now, and now obviously there's new discussion about the potential risks in leveraged loans, but we want to get down there at this point. But anyway, the whole point was it wasn't in our policy. So there was no simple way to execute on something as tactical as that was when we saw that opportunity, because we couldn't implement it fast enough. And by the time we actually did ultimately have a dedicated bank loan strategy within our fixed income book, but there was just no way to get there in time to take advantage of that opportunity. It was more of a long-term thesis that we still had, but the thesis was different than it was on that short-term tactical trade. In the long run, what we did was we redesigned the entire program to barbell the risk out. I can't do exactly what Susan does in the E&F space, but I wanted to be more unconstrained from a public pension plan standpoint. So what we did was we took a subset of the BC Ag or the Lehman Ag or whatever, the Ag, on one side of the portfolio. The other side, we did a global unconstrained credit, which you can go anywhere from investment grade, high yield, EMD, and also geographically around the world. And I kind of call it constrained unconstrained because being a public pension plan, we still had to get the buy-in from our board. We do have a conservative board, and being a well-funded, highly liquid plan, we still had to maintain that constituency that we have that we're responsible for. So we didn't want to get over our skis, and we didn't need to. So the bottom line was we had redesigned it that way. It started to produce a lot more income for us, and at the margin, our total risk, depending on how you want to define risk, and that's a whole other panel discussion, but actually didn't move up much at all. And so we did get ahead of the Fed. That one we actually, before the markets anticipated, let's say, the Fed start to move and increase rates, we actually got in front of that. And so we're punching out double-digit returns, which was ridiculous net of fee returns in our fixed income portfolio. That's since come back down. But that's one example. So the short term, no, we couldn't execute, and it's a challenge for us. But long term, we could still, every couple, 3 years, reallocate and restructure the portfolio.
So maybe taking the other perspective and the other side of that, it takes maybe a couple of years for you to move, Jeremy. Susan, maybe as a family foundation, private foundation, family office, maybe can move at a slightly different pace than that. Can you touch on sort of the way you approach asset allocation and strategic versus the tactical decisions that you can make as the market moves and you guys see opportunity or risk present themselves?
We have a couple of competitive advantages that we use. One of them is a brand, so people want to participate in the wonderful philanthropic efforts that Eli supports, and certainly one of the reasons why I love my job. Another one is flexibility, and another is the speed at which we can move. And I think the latter two are really a function of a great governance structure and organizational structure that we have. So we work for a very sophisticated principal and with very sophisticated, helpful investment committee members who understand investment strategies, understand risk, and are willing to withstand volatility. And I think those are all very critical components to building a robust long-term portfolio. And on top of that, our decision-making process can be very quick. Internally, we are a very small, close-knit team, which means that we always stay busy, but we run in parallel on a lot of things, and so we're constantly in dialogue, and it's a very smooth process internally. And then the decision-making process, because of the people around the table, can also happen very rapidly. So what that means is that from our approach in terms of investing, we will take strategic points of view. So we will do research and have themes that we may invest against. So that could be an industry, a strategy, a region, and then we will find the best ways to express that theme. But we'll also be very opportunistic and bottoms up. So we want to partner with the top tier managers and the top tier companies, regardless of when that happens, and we're able to be flexible to execute against that. Another element of flexibility is that while we are largely partnering with managers and allocating to funds, we are also able to invest directly. So on the private side, we have done co-investments with our private capital managers. On the public side, we buy individual securities and we manage those securities in-house. And we also occasionally trade options and derivatives to directly hedge our portfolio. So with that flexibility, we can tilt and press into the areas where we have a particular point of view. We can be tactical, and again, because the people around the table understand investment strategies and are also very additive in terms of their network and knowledge to our own sourcing and diligence process. We can move very quickly on those. And then we also aim to develop really close relationships with our managers, obviously for information flow and access for the underlying investment that we've made with them, but at times they can also be a very helpful resource when we as a small team are trying to triage and triangulate an investment. And all of that becomes a virtuous cycle that hopefully improves our investment process and our ability to execute more and more over time.
God, it sounds like there's a lot of flexibility and tools in your toolkit there. Given that this is an asset allocation panel, I think in discussing some of the concepts with Doug, who manages and advises, and you pointed out you sort of have 5 different risk buckets that on the advisory side of the business that you're putting your clients into, from lower risk to higher risk, and setting an asset allocation from them. Sort of common perception in the industry is that asset allocation, decisions are going to dominate your return profile and prospects. And I know that you have a unique view on that and have delved into there. And so maybe your thoughts for the folks here on that.
Sure. Well, I participate in some of these panels, and I constantly hear, that asset allocation is all that matters in a client's portfolio, that 90% plus of the returns are driven by that. So I actually went back and read the studies that this number comes from, which are 40 years old, and the returns are 40 years old. And, there's some, all I'm trying to say is that security selection is very, very important as well. It's not just asset allocation. I'm not meaning to say that asset allocation is unimportant. It obviously is, particularly with bonds where they're at these days. But security selection shouldn't be overlooked. And the studies that people cite, like I said, number one, they're 40 years old. Number two, all they do is look at is basically a 60-40 portfolio. They're looking at the top 100 institutional funds back in the 70s and 80s, where all they owned was a large cap S&P 500 manager, where they owned maybe 20 S&P managers. And guess what? When they averaged the 20 managers, they came up with average returns, less fees, which is similar to the active-passive argument that you hear these days nonstop. So, and then from that, they concluded that stock selection wasn't important. Well, there was no small cap, there was no international, there was no alternatives, there was no nothing in this bucket other than what I would call very plain vanilla analysis that was done by an asset allocator, by the way. So, not terribly surprising. But anyway, so all I'm trying to say is that security selection, and even within that study, the difference in benchmark returns on security selection was, -4 to +3, a 700 basis point per annum swing difference depending on what securities you actually selected, how you hired managers. So manager selection, I would argue, is actually very, very important, because even a % or two, as I'm sure Jeremy knows, over long periods of time, makes a huge difference to somebody's net wealth. So that's, I guess, my point of view on that.
Sorry, I just wanted to make one comment and to support one of the comments you just made, Doug, is that so security selection, since we don't do anything internally, would be a challenge for a pension plan unless we had the portfolio team in-house to actually do that. Manager and mandate selection is extremely important to support your point there. The dispersion of returns, if you focus on, let's just say, the private equity space, 700 bips is nothing. You can go from a top quartile manager of plus 20-ish, total return to a minus 14 or some massive dispersion in returns, and it's been pretty consistent over a long period of time. So from our standpoint, we agree. Manager selection is definitely critical, and I think it's important, especially if you're late cycle and you have a macro view. From our standpoint, how do we want to execute upon that, and where do we want to invest in that space, and then trying to find the best investment managers out there to provide that service to us. Having said that, I don't disagree with the fact that some of those studies are old and they were based on different types of data. All I could say, our personal story is we do look at our personal portfolio attribution over time, and granted the bulk of it's in the public markets, but historically our attribution over time has been driven, at least statistically driven, the majority of it from long-term asset allocation decisions and the tilts within that. Not saying that there wasn't and isn't an impact at the manager selection level or even the security selection level, there is. But I think the biggest swings in our portfolio returns have come from major decisions in asset allocation.
Yeah, Doug, I won't tell you where I was 40 years ago when those studies were being done. Maybe to put some of this in context, at the Hilton Foundation, we manage $6 billion in aggregate charitable assets on behalf of the foundation and related charitable entities. We really build the portfolio on a bottoms-up basis, looking for great partners that we can invest in, funds that we can invest in, that have strategies that we find compelling in the right teams, and we'll sort of find room for them within the portfolio. Today, it's about 42% long-only equities, usually with niche kind of focused strategies across the globe, so not traditional kind of large cap managers, and a 12% allocation to treasuries and a little cash, and the balance is in what I guess is referred to traditionally as alts, with about 16% in private equity, 16% in hedge funds, and then 7 and 6% respectively in real estate and natural resources. I know that, Doug mentioned sort of the studies that were done, traditionally kind of 60-40 plain vanilla portfolios. As you think about the way the industry has evolved, I think it's interesting, Brian, where you sit today, where the nexus of alternatives and in the Nuveen TIAA platform, if you can sort of touch on that and your perspective.
Yeah, we get asked a lot what our capital market assumptions are for the next 10, 20, 30 years. And while we don't publish them, I'm pretty comfortable saying that they're a heck of a lot lower than the performance that you would have seen over the last 10 years. So
how much lower?
So over the last 10 years, if you were invested in there's a lot of really smart investors out there who've just been in the S&P 500 over the last 10 years, and you've gotten about 15% per annum just by being in the S&P 500. Very hard to beat that with a diversified asset allocation, especially one that's looking internationally. Over the next 10 years, what history would tell you is to expect something more like a third of that, 5 or 6%. Doesn't mean it's going to happen exactly that way. There's a range of uncertainty, but based on where the market is valued today versus where it was valued 10 years ago, which is going to go down as one of the all-time best entry points, you have to expect a lower rate of return just simply based on valuation. And in case you haven't been paying attention, interest rates are basically where they were 10 years ago today. We have a 10-year Treasury rate that if you want to invest in, get 2.2% from the government for the next 10 years, you're free to do so. But most investors, when you're combining those two things, are going to want to do a bit better, even if they can diversify away from that kind of naive 60-40 portfolio. One of the things we did, partially based on our outlook for these traditional liquid asset classes, is to include direct real estate investments in our multi-asset mutual fund. So this is somewhat unusual because you're basically introducing an inherently liquid asset class into a fund that has daily trading. We obviously spent a lot of time thinking about how to size that, what properties to add. But one of the reasons we did it was somewhat of a less optimistic take on what the publicly traded markets, the liquid markets, are going to give you over the next 10 or 20 years, but also based on the fact that we already had the in-house expertise on real estate. We already managed over $100 billion. We had the teams in place who could kind of scout locations for us, do the acquisitions, manage that portfolio. So now about 5% of those life cycle funds, whether you're talking about somebody who's far away from retirement or in retirement, about 5% is in direct real estate. That was carved out of fixed income for the more conservative portfolios, mostly carved out of equity for the more aggressive portfolios. And the idea is you stabilize the portfolio over time more so than if you had just had stocks and bonds. It tends to be a less volatile asset class, one that has a less correlated return, although it's not perfectly uncorrelated like some studies might have you believe. But really just to supplement the income coming from fixed income while delivering a bit more of growth potential, more like the equity side of the portfolio. And so far in quarters like the fourth quarter of last year, or probably so far in the second quarter of this year, it's served us well. And I think introducing more alternatives is something we're certainly looking at. The real estate was the lowest hanging fruit for us.
Great. I see a lot of folks with pen and paper waiting in the audience, and I think this is a good backdrop, but I think they want actionable ideas so they can go back to their desks and start trading. So I would love to push people on the panel to at least kind of share an idea. We'll get to questions in a minute. To share an idea or a thought where in their portfolio they're either overweight or underweight, tactically or strategically as they're looking at the portfolio today, a recent positioning that they've done within the portfolio, or perhaps something that you see yourself doing over the next coming months or so. So we can hear and kind of just go down the line. Maybe Susan, we'll start with you. Your best ideas, please. Confidential, not being recorded.
We tend to be a little bit more opportunistic, so it might be easier to touch on some of the things that we've pressed into and what we're not looking at today. So our portfolio, another way to look at it is about 50% in some kind of illiquid investment. And another way to look at it is about 50% in alternatives. So we have healthy exposure to alternatives and illiquidity, and we continue to be active and participate in that, but it's a very high bar to add to those areas today, and we're mindful of liquidity. So what we've done from that perspective recently is to manage our liquid bucket and improve that overall. So we've reduced our exposure to some strategies that were maybe mid-returns and mid-illiquidity, preferring the more barbell approach where if it is going to be an illiquid investment, we want to certainly get paid for that. Another way that we've pressed into managing liquidity is adding to co-investments, which have a faster path towards liquidity. And then we did, over the last couple of years, add a little bit to our defensive, uncorrelated hedge fund strategies. So both the liquid positioning and adding to those strategies are a reflection of feeling like we're very late in the cycle, but not wanting to take ourselves out of upside, given that even though we have been late in the cycle for the last few years, the economy continues to perform and risk assets continue to deliver returns. So we are continuing to participate in that. Over the last year, we also did take a long-term view in wanting to be overweight the index in China. So China currently represents about 4% of the MSCI ACWI, but it's a much larger percentage of the world and the economy, depending on the metrics that you look at, ranging from 15 to 20%. And we had already had positions in China. We started out with partnerships with global managers that had exposure to the region, and then we moved to partnerships with some local managers, and we added to our position in China largely through liquid strategies to preserve some flexibility, and we also purchased some individual securities as well. Some areas we're not spending time on tend to be kind of that mid-return or mid-illiquidity and potentially with more macro risks. So we've been less active in energy, commodities, infrastructure, real estate. We're underweight intentionally Europe and some other parts of the developing world.
Great. So Jeremy, other than reducing your return target, what are some of the recent changes in the portfolio?
That's really all we need to do is give me a 5 and I'm good to go, maybe a 4.
Any of your board members in the room?
No, I hope not. And we're not going to stream this, by the way. This is off the record. So the problem with my best ideas is that practically everyone in this room can front run my best ideas. So you can execute a lot faster on it than we can. So some of the things that we've been looking at, not too dissimilar to what Susan was talking about, but so some examples. One was given where we are late cycle, but longer runway, we're not completely defensive by any means. Some of this is going to be structural in nature just by design, and some of it is tactical opportunities, as I mentioned, within the private space. So one thing we did as a result of, we tried to get equity beta out of the portfolio. And one of the mistakes I think people make is trying to identify where equity beta exists, because it really exists in a lot of places within your asset classes. So anyway, one of the things we did, this was just a simple switch, and we're somewhat contrarian a little bit. And again, we have, because of the fact we don't need to get over our skis because we are well-funded and have low payout ratio, we had this low volatility equity strategy. It was a 5% allocation. And so what we decided to do was remove that from the portfolio, reduce our public market exposure, and as all the public pension plans were getting out of hedge funds, we actually were leaning into hedge funds. But the way we designed it, and this was, again, partially to ensure that board turnover didn't become a problem down the road as well, was we weren't looking to knock the cover off the ball with our hedge fund strategy. We're looking for as market neutral as we possibly could be, low volatility, a decent amount of diversification, but obviously there's fee-related issues, but the way we structured it was we wrote a policy around it and we took it out of where it was within a larger asset allocation. And so our dedicated hedge fund now is it's gonna produce probably low single digits, but it's been producing a 0.18 beta against the AG, against the S&P, and it's doing exactly what it's supposed to be doing, and we just executed on this probably about less than a year ago, but it's fully funded within the last year. And it's not enough data set there, but I think it's going to continue to produce the results that we're looking for, not from an absolute return perspective, but from a diversification, low volatility, market neutral perspective. So that's one example. Within private equity, can't talk about our pipeline, but I could talk about some things we've recently done. That program by design is limited because we want vintage year diversification, and that platform for us, I've been there 12 years, was really started it from scratch 12 years ago. There wasn't really anything at all. So our strategy there is more concentrated. We typically have a $100 million bite size. I want less GPs, less strategies, more material. I don't like to use the word bet, but more material allocations that will move the needle. So some of the things we were looking at there, higher quality, less leverage, We're not fully there, I don't think, from a distress standpoint yet. Distressed is, I think, a little bit easier to call because every GP in the world that does run distress is going to be in the market once the markets completely turn on us. So that'll be a little bit easier to call when there is distress in the market. But what we have done is we have looked at some turnaround / distressed funds at a later vintage so that they do have the opportunity over the next several years to execute on that. So we've deployed some capital there. We did add some growth equity to the portfolio, but low leverage growth equity. And then on our real estate program, we've been bringing, it's a cash flow producing portfolio for us. And so we had dedicated a lot more partnerships in the value add and opportunistic space in real estate and have since, and those are fully committed and have been producing really good results. We were actually punching out mid-teen nets for a while, which is not a sustainable real estate return. I loved it. I'll take it all day long, but now it's come back a little bit to earth. But our long-term strategic allocation within our real estate portfolio is 70% core, which I think valuations are too high, 20% value add and 10% opportunistic. And so we widen the bands in our policy to deploy more capital in the value add and opportunistic space over the last, call it 5, 6, 7 years. And that's worked well for us. And now we're bringing a little bit back to home with some core plus strategies in real estate. And like Susan, back to the private equity, we are also building out a co-investment program. We can't do too much of it specifically in-house, but we're structuring some special vehicles in order to capitalize on co-invest opportunities.
Great. So if there's any private equity GPs, he brought his checkbook, $100 million right after the panel. Just tackle him in the back. Doug, I know that, touch on any themes. I know that, Susan mentioned Europe. I know that you guys have some investments there and perhaps an interesting view and maybe some other places.
Yeah, I mean, in general, we're overweight U.S. equities, underweight developed markets, overweight EM and equities, and underweight fixed. Probably the most interesting or tactical thing that we've done that hasn't worked out yet, but hopefully it will, is in Europe. We've been underweight Europe. We're not fans of Europe at all long term, but the only reason to have a weighting there at all, as far as I'm concerned, is to participate in a cyclical upturn, which is yet to materialize. There's, in my opinion, basically in a recession already, including Germany. But when that comes, the European bank should be a good place to be. So tactically, we've taken small positions in some of the ETFs that specialize in European banks and asset managers over there, with the idea being that we'll get a lot of leverage out of that if, in fact, Europe ever actually recovers. And if it doesn't, we have a small weighting that won't kill us. We'll be underweight and still outperform the area. So that's probably the most tactical thing that we've done.
Yep.
So all of our tactical asset allocation decisions happen in what we call our actively managed family of funds. We have index-based funds that basically asset allocation is going to give you 100% of your return because there's no underlying security selection, there's no tactical asset allocation. So in some sense, we're view takers from the underlying managers as well as view makers when we have a strong tactical call across various asset classes. And I think because we can see down into the individual securities in the portfolio, we can sometimes make adjustments based on, well, if all the managers are leaning toward growth, but we don't share that view, we can keep the managers, but we can take that tactical asset allocation out of the portfolio. Right now, what we're seeing across the board is, I think, a higher premium on income. That's a view that we actually share. If you're looking at higher income securities, whether it's within the equity market, within the credit markets, because we don't think markets are going to rip upward, even if the economy avoids recession, which we expect it to. I think there's going to be a lot of disappointed investors who are looking for a Fed rate cut that may not come, and there may be a lot of disappointed investors who are still looking for a trade deal between the U.S. and China that isn't going to come, which is probably going to prevent, at least for the next couple of quarters, the markets from fully recovering or getting back to the all-time high levels, which, by the way, were a month ago. It seems like a long time. And because we don't think that the total returns are going to be all that high, a larger percentage of the returns for most asset classes are going to come from dividends or interest payments or some other form of income. And so we're seeing more managers switching to higher income portions, higher income names and sectors in the S&P 500, like consumer staples. We're also seeing, because we think we'll avoid recession, probably a little bit more of a move to credit risk versus interest rate risk as the benefits to credit risk continue to look high relative to the expected return from just being in pure interest rate sensitive securities. And that gap has also widened out throughout the month of May. So on a very kind of micro tactical level, it seems like income is becoming more of a theme regardless of which manager you're talking about or what asset class he or she is operating in.
Excellent. With that, I think we have just about 5 minutes left and want to reserve a couple of minutes for the audience to ask questions. There's a lot more that we could discuss up here, but in 45 minutes with the panel that we have, it doesn't quite do it justice. But with that, we'll open it up. I don't know if there are any questions out there. We have one up front.
It seems to me that you all identified passive investing as a potential problem going forward.
I'll repeat the question. It's centered around passive investing, which was touched on by some and not others. I don't know if there's anyone who has a particular view on passive investing versus active investing that they want to kind of feel that one.
I could just share and this again goes back to us being a little bit more contrarian. A lot of our peers have been moving more passive, and obviously that's become a significant trend in the industry. We've actually been leaning into active. We're probably about 80-20 now, active versus passive. Honestly, late cycle, if you, again, going back to either security selection or manager selection, if you can find the right active managers, they could predict to the downside, and we underwrite everything to the downside anyway versus just going along with the market. Again, it depends on your macro view and if and when that's going to come and how much of that beta you want to take. We've been able to generate annualized about 30 to 40 basis points in alpha over the years, but we've seen alpha decay. But at the same point in time, if we can negotiate a good fee structure and we have, we think we can get a good mix of active management, we think it's beneficial to the overall risk-adjusted returns.
Yeah, and maybe from our perspective at the foundation, we employ about 50 managers across all asset classes, and what we're looking for is real active managers, not sort of quasi or sort of index plus. And so you're talking about a manager that runs a 10, 15 name portfolio where, and the fee structure's done in a way, and I was at the hedge fund panel a little bit before, where we're not paying for beta, but we're paying for alpha that they can generate by building a real concentrated portfolio in a specific niche or sector or geography that they have an edge. So whether that's a small cap U.S. technology focused, stock picker, whether that's an Indian focused stock picker where we think there really is opportunity there for them to outperform. There's obviously tracking error. You can have negative alpha as well, but across the portfolio, we think we're able to put together a diversified enough total portfolio and generate some real returns there. Back there.
To what degree have you integrated ESG issues in terms of either your strategic or tactical decision making?
I knew that was going to come up, Mark. Thanks for bringing it up. We were talking about that before. So just to give my perspective on ESG, if I say anything bad, by the way, about ESG, I'm sure that big hook will come and just yank me off the stage. I think the issue that I have as the CIO of a pension plan is how do you execute and implement ESG? And educating, we just had an ESG education for our board, and I think the critical factor for us is that, first of all, ESG's been around forever. Now it just is called ESG. We don't want our investment managers going out and buying the worst governance, companies on the planet and ones that are dumping oil or whatever they might be, or whatever they might be doing, right? We want them to buy good quality underlying assets and securities. So to us, the issue I have is I don't want to implement an ESG-driven strategy in the sense that now that becomes the leading factor in the decision-making process to allocate across different asset classes. So the first question is, where do you even put it? Do you put that in your private markets? Do you put it in your public markets? If you put it in public markets, we have to go through RFPs. So now does that become the number one ranking factor in our RFP criteria? So what we've done historically is we incorporate ESG by having conversations and having expectations with our investment managers that ESG is a factor in their decision-making process on a regular basis. So their security selection incorporates good governance and social-related issues and what have you. So they're buying good quality names based on that as one of many factors. And that's how we've implemented it, so it's not a dedicated ESG carve-out, because I've seen a lot of plans, at least in the pensions plan space, that have put carve-outs in place that just were a challenge to be successful.
Do you have a view down here?
Yeah, that's effectively what we're doing as well. We don't think ESG belongs in a carve out. Like 5% of your portfolio is going to be ESG, and then the other 95% could be anything. So all of our managers across Nuveen have signed on to like a principle that basically says these are a list of factors that we're going to look at when we're deciding how to manage money, which companies to include or not include in a portfolio. So effectively, it's already permeating into this fund of funds allocation that that we're running. And ESG is one of our pillars at Nuveen. Income is one of the other ones, so I'm going to get double points from Nuveen for talking about two of our pillars on this panel discussion.
Excellent. Maybe we have time for just one more. Any on this side? Here we go.
How are you structuring your fixed income part of the portfolio given the yield curve, like staying really all short term?
The question was about how people are structuring their fixed income portfolio, especially where we are with the way the yield curve looks.
Yeah, we're tactically overweight short-term fixed income versus all fixed income, which is not the tactical idea I thought was kind of the most exciting, so I didn't mention it. But yeah, effectively, if you're not being paid a lot, at least on the treasury curve, to take a longer duration risk, then we feel like you can take a little bit less risk because we do see rates moving up in the U.S. before they move a lot lower. But that doesn't mean that's the only trade in the portfolio. There will be other markets like the municipal market where you're still getting paid to take a longer duration position, and there's enough of a steepness to the yield curve. So it's not uniform across all the portfolios that we're managing. But certainly if you're looking at the treasury curve today, you wouldn't be inclined to go out to 7 or 9 or 10 years based on where the rates are right now.
I just got the red light from the back of the room, so with that, I think lunch is next. So I'd like to thank you all for attending. I'd like to thank our panelists, and enjoy the rest of your day. Thanks a lot.